Edutrainment Workshops, the insurance industry's leading education and training platform, presents Life Insurance, the entry-level series, the products, the underwriting, and the planning applications to position your practice as the premier provider of insurance products in your community. Get on board, get on track, get to where you're going. And now, your Edutrainer, national insurance columnist, Steve Savant.
Well, welcome everyone. I'm Steve Savant, your Edutrainer and coach for our Edutrainment workshops, and these workshops are our introduction into annuities. And again, welcome if you're coming from another sector. Maybe you're a property casualty agent, maybe medical agent, maybe you're coming from the bank or even the security area. We welcome you into annuities. It really is hot right now because of the preservation of principal, and indexing has probably got to be the #1 actual annuity that we're selling day in and day out. There's a lot of reason for that. We'll get into that all next week. What I want to do now is remind you that any of the documents that you see, and if you say, Steve, some of the words you're using, well, we have a vocabulary list so that you can go ahead and order it. All you have to do is write me at thebiz@brokersalliance.com and I'll send it to you. It really helps you walk through all the words that I use. If you forget it, you can look at, oh, that's what he meant. It's really great, and just order it, thebiz@brokersalliance.com. And you can order any of our documentation. You see these things on the board. It says, Steve, I love that thing on deferred annuity, or yesterday we got pounded on rule of 72. Send me those docs. We'll send it to you. Just write me thebiz@brokersalliance.com. But if you missed any of our shows up till now, you need to hop out to our site at www.brokersalliance.com. As soon as you come to our homepage, hit the on-demand video section, go right into the archives, and all our Edutrainment workshops are there, life and annuities, as well as our daily internet talk show, the Business Insurance Zone, which I host, and of course my weekend piece, Welcome to the Weekend with Steve Savant. Okay, enough of commercial. Now I want to talk a little bit about deferred annuities again. We're still on that for today, and we're talking about methods of purchasing. Now we talked about lump sum purchase, and we talked about the ability to go ahead and buy annually, and we talked about the ability to dollar cost average or pay monthly into it. But now there's also the reverse. What are the payments from an annuity? And I want to walk into the basic ones first and then use the monopad in a second. Lump sum withdrawal. Now, remember, lump sum withdrawal, I just had a client that should not have done this. They withdrew from an annuity that they've been holding for 10 years. I could not believe that the agent didn't circumvent this. They took their entire annuity in constructive receipt. I even went back to the company to try to give them to reverse that, because they did not realize that when they took all their money out, that would be a taxable event on the entire amount of the gain, which, remember, they've been holding it for 10 years. But worse than that, their bracket, they're still in their earning years. They're sitting there with a marginal blended bracket, because we're in a progressive tax system. Think about this. They were paying around 27, 28%, somewhere in that area, blended bracket. But now with this annuity sale, they're going to be in the 33% bracket. And it was needless. All we had to do is to do a little bit of strategic issue. They're not going to use the money all at once. It pains me to see people doing lump sum withdrawals, especially in your earning years, which is just going to compound your taxable event and basically almost neutralize the very reason why we bought the annuity. The second thing I want to talk about is a partial withdrawal. Now remember, we talked about you're able to take certain withdrawals under the provision. Some provisions in annuities will let you accumulate those withdrawals if you didn't take it the previous year. You want to always keep online. I may want to be able to, I need a stream of income regularly, and I don't want to worry about the withdrawal. I could do a partial annuitization. Every contract's different on how this is framed, so you need to look at the contract. And again, if you're selling 3 to 5 different annuity contracts, you need to order, as I said Monday, you need to order the sample contracts from every carrier, get a good idea of what it says, the policy provisions, the perks, so that you can explain it to the client. Believe me, if you do a good job on this, the client's going to have a great policy ownership experience. Now, when I look at these 3 things, those are the basic ones, but now we have a potpourri, a small menu that I want to go over with you. And to do that, I want to go to the Mondo board to talk about deferred annuities in these other payout scenarios. Now, these next options are even more important to know. Here's the first one: is life-only annuity. Regular payments are made for as long as the annuitant lives. When the annuitant dies, the payments cease and no refund is made. Now remember, there are contracts that actually give you a refund experience if you didn't collect at least your principal. Some even put a little put a little bit of gain on it, but you got to look at every contract to see what it says and how you can actually take constructive receipt of that if that actually occurred. Also, life with a term certain. Regular payments are made for the life of the annuity or a specific number of years. If the annuitant dies before the specified term, then those annuity payments go to the beneficiary. So now I could add maybe life with 20 years or life with 10 years. And then if something happened to me before those times certain, my actual beneficiary would benefit from that. And remember, heads up, I want to look at, is it better to put joint annuitant on here or keep them separate? I'll always look at the math behind it because it does matter. And remember, we're living longer, so females are living longer. I want to say, is it a better deal to do it with them together or not? Then joint and survivor. Regular payments are made over the lives of two individuals. When one dies, the annuity payments continue to go on. What I did was, we looked at a case about, 3 weeks ago. It was about $500,000. And I did both sides of the fence on this. I did individual. I tried to see them together. I did the math based on their timelines. And remember, as I've suggested before, I actually use a life section, part of the life application section called the medical part 2. I actually asked them both the same questions. I looked at their timelines and established myself helping. A good resource was the Society of Actuaries 2008 VBT tables to kind of get an idea where I thought my life expectancy was going to fall out. Remember, it's only a guesstimation, and I look at that to see how can I quantify what kind of numbers we're going to look at, and should I do joint and survivor? Should I do 10 years in life, 20 years in life? I like to show it all, and many annuity illustrations now will show you all your options, which I love, because then I can kind of look at the math and then apply my life expectancy to both clients, and then I can really have a good idea, a good model of where I want to go. Also, refund options. Regular payments are made over the life of the annuitant. However, if the annuitant dies before the policy owner's investment has been recovered, the balance is refunded to the named beneficiary through either a lump sum or continued annuity payments. Now, of course, if I had a child that I was using this for and I wasn't really sure that they would do a really good job taking constructive receipt of a lump sum because I'm not sure they're really good with money yet, I would go ahead and use this option because I'd rather have them not get the lump sum because they'd probably come home with a new vet. Now, another one, specified period. Regular payments are made for a pre-selected number of years. If the annuitant dies before the specified period is expired, the payments are continued to be to their named beneficiary for the remainder of the term. So if I buy a 10-year certain and I were to die halfway through it, my wife or any other beneficiary I would assign would get the remainder of that, and so that they're never out that money. And also specified amounts. I have payments of a set amount are paid out regularly as long as there's money in the account. So maybe my account's growing, I'm taking out a certain amount all the time, and I'm just going to take it out until I deplete it. And as long as my performance of my account is doing well, I might be able to go a few more years than I thought I could. It depends upon the rate of return. This is not used that much, but I do bring it up once in a while when I see that a client, especially maybe in a variable contract, he has a little more propensity for risk. He understands that he thinks that the market's going to go up. I may look at this. Now, I want to look at another area here called the value of tax deferral. Now, let's apply some of this to what we've been talking about all week, the power of tax deferral. And because annuities have that tax deferral feature in it, it's really something. Let's look at our assumptions just for our case example. And again, you say, Steve, I love this case example. Can I have it? Sure. Just say, Steve, I want the value of tax deferral with that basic example that you gave. Just write me thebiz@brokersalliance.com and I'll send it to you. The initial sum is $20,000. The growth of the taxable investment is at 6%. Growth deferred annuity at 6%. Current marginal brackets at 35%. The tax bracket at retirement is going to be 28, maybe. And the current year is 2012. So I have 20 grand, and if it was exposed to a regular taxable event at 6%, or growth deferred annuity at 6%, and everything else is equal. So the only difference here is it taxable in that same year, or am I deferring taxes? Everything else is static. So let's just look at it. We take our $20,000 and we're earning 6%. Our taxable interest, our tax deferred, and our money before additional accumulation, and taxes paid at the time it's withdrawn. So what I'm looking for is, am I getting any reasonable savings by deferring? All things being equal, Let's look at 5 years. So when I look at 5 years, the difference isn't that great. And as I said a couple days ago, the time of deferral based on the interest rate environment we're at today is probably around 8 years. So you'll notice that in 5 years, I actually do make a little bit more money. So it's $374 with the annuity all in. That means I've paid my taxes at the time of withdrawal. I've taken constructive receipt. When it's all said and done, I have $374. But the power starts to begin in about the 8th year. And here I'm showing in 10-year increments. Now it's $1728 over 10 years. That small delay in the small amount, and think about it, if this was a $200,000 case. If this is a $200,000 case, these numbers are dramatic. I'm just using a small, easy to understand concept so that a consumer, a basic consumer, can see this and get it. Look at this. 20 years down the road, at a 6% hold, taxable versus a tax-deferred annuity, I'm sitting there with a run now of $8,300 difference just because I delayed the tax. Now remember, I still had to pay it. I just delayed it. And to me, this chart is so powerful to show, especially the higher the bracket, the more powerful it is. And especially when you have a little more higher end, upper middle class client or an affluent client, these numbers really matter. And remember, if we're deferring over our period where we're taking Social Security out, this income, as long as we're deferring it, will not dicker with our Social Security benefits being taxed. So deferral can help even in your Social Security payments before you take constructive receipt of the annuity. While you're deferring it, it won't interfere with that. So it's just another thing to look at. So when I'm looking at this, the value of tax deferral, I'm looking at 30 years out now, and just on this small $20,000 investment held for 30 years, just because I delayed paying taxes until 30 years later, I actually was able to pull down $24,556. Now remember, this is predicated that my current tax bracket at 35 is going to be less later on at 28 in my retirement. That my retirement income is always going to be lower than my actual earning income. Now, again, I don't know what taxes are going to do, and I don't know too many people that are making any kind of diagnosis of what it's going to be like or making any future predictions. But under this scenario, you can see this is a powerful tool to be able to have you look at the value of tax deferral, and you say you want it, I'll go ahead and send it to you at thebiz@brokersalliance.com. Now I want to go to the Mondo pad, and I'm going to look at one more feature before we close out the workshop today. Now the last chart again talked about the taxation at the end game, and I just want to make sure we go over the tax treatment issues of ordinary income tax using annuities. The tax treatment of payments are made from annuity will vary depending upon how the life cycle of the annuity payments are made, and in general though, the following rules should apply. Before annuitization, funds withdrawn from an annuity prior to annuitization are considered to be made first from interest and then growth. Remember, we talked about it Monday? Last in, first out. So any gain, any payment made, that's going to be gain. Until we exhaust gain, we can't recapture basis. And remember, that's only true if we're talking about non-qualified annuities. And any of these earnings are going to be taxable at ordinary income. We are not taxed at capital gain, we're taxed at ordinary income tax. So whatever the marginal blended bracket of the client is in the year that we take constructive receipt, that's the number. And remember, it is subject to the annuity owner. If they do this and take constructive receipt, if it happens before 59.5, it could be subject to the 10% penalty in most cases. So just remember, am I going to take this out as a withdrawal? Maybe I should annuitize it just to circumvent that issue. But a lot of times you're not ready to take that kind of a stream. So if you take out a withdrawal before 59.5, you're going to have to pay tax. It's going to be treated all as gain, and negative or positive. If it's before 59.5, it's a 10% penalty for doing it. If you're really in the low no, if you're in a low no bracket, maybe 10% isn't that bad. After annuitization, regular annuity payments are treated as being comprised of earnings and part of the return of investment. So that treatment of annuity, you get your basis amortized across your life expectancy as you're getting a piece of your gain. So that basis coming back actually gives you a bit of tax treatment. And for estate tax purposes, any amount payable to the beneficiary under the annuity by reason of the owner's death is includable in the owner's gross estate. So just keep that in mind. You're not escaping estate taxes here, and there's ways to go ahead and do this with different trusts, but strictly by the actual ownership, it would transfer into his estate. So you just have to be aware of these.
This has been an Edutrainment Workshop, the educational division of the National Insurance Clearinghouse. the marketing arm of Brokers Alliance.